All right, so I've got a question for you. What in the world does a trendy British banking app have to do with a massive US credit card company? And then what do either of them have to do with a huge trade deal between two global superpowers? Sounds totally random, right? Well, it turns out they're connected in a big way. And today, we're going to connect those dots.
So yeah, here's the puzzle we're putting together today. A UK neobank, a US credit card giant, and a major trade deal. I know, it doesn't seem obvious at all, but believe me, when you find that common thread, it kind of reveals the hidden logic of how the entire fintech world actually works.
And that's exactly what we're going to do. We're going to connect those dots. We're starting small, right on the ground floor with a single company's big move. And then we're going to zoom all the way out to see the global stage, the big picture that sets the rules of the game for everybody.
All right, first up, let's dive in at the company level. We're talking about Revolut's huge bet on Mexico. This is a classic, ambitious play by a neobank looking to expand into Latin America.
And when I say ambitious, I am not kidding. Revolut is reportedly dropping over $100 million just to get its banking operations off the ground in Mexico. I mean, this is not a side project or some small experiment. This is a massive, high-stakes investment, plain and simple.
So, the big question is, why Mexico? Well, this list right here, it's pretty much the perfect recipe for a fintech disruptor. You've got a huge population, a ton of people who are underbanked, and a really strong flow of remittances. People sending money back home. Plus, there's this rising demand for digital banking. It's just a prime market where the old school banks haven't completely locked everything down yet.
The source material had this fantastic sports analogy that just nails it. Think of Revolut as that big-name free agent signing in the offseason. They scouted the field, saw a market that was totally underserved, went out and got the contract, which in this case is a full banking license, and now they're lacing up their boots, ready to get on the field and absolutely dominate. So what's the key takeaway here? It's simple, really. This move signals a huge shift. The fintech scene in Latin America just got a new big league player on the roster. And trust me, the competition is about to get a whole lot hotter.
Okay, so that's the micro view, right? One company making a big, bold move. Now let's zoom out a little bit to what we'll call the meso level and see how this all builds up. We're going to take a look at the health of an established market by looking at Synchrony's latest report card. And let me tell you, it's sending some seriously mixed signals.
So check this out. On one side, Synchrony's earnings report looks fantastic. I mean, net earnings of almost $967 million. That's a huge beat. But, and this is a big but, there are some warning signs flashing. The actual volume of purchases and loans on their network, it slipped by about 2% compared to last year. See the tension there? That's what I'm talking about.
And this chart just lays that contradiction out perfectly. Look at that, a massive 61% jump in earnings per share. That's pure profitability. Awesome. But then, right next to it, you see that 2% drop in purchase volume. That's what people are actually doing, or, well, not doing. So the company is making more money, but people are spending a little less. So what does that actually mean?
Okay, I absolutely love this next analogy from the source. It's like one of those super hyped sneaker drops. The resale value is through the roof. That's your earnings beat. But some of the sizes are still sitting on the shelf. They didn't completely sell out. That's the slip in volume. So the hype is definitely real, but maybe the underlying demand isn't quite as strong as it first appears.
So the big takeaway from all this? The consumer credit market is holding up. It's resilient, for sure, but it's not in a full-on sprint anymore. It's more like a steady jog. And think about it. That's a really crucial piece of the puzzle for a company like Revolut, who's betting big on future consumer growth.
All right, time to zoom all the way out. We're going to the highest level now, the macro environment. We're going to talk about the US-China trade truce and how geopolitics, believe it or not, basically sets the weather for the entire fintech industry. So to really get what's happening now, you have to see it on a timeline. We've just come out of a period of really high tensions, tariffs, all that stuff. Now, here in 2025, there's a new framework in place, which is signaling that things are cooling down. But, and this is super important, the really deep-seated issues around things like IP, technology, and subsidies, they are absolutely not resolved. They're just waiting in the wings. And all of this leads to a really key concept you need to know: strategic decoupling. It sounds complicated, but it's pretty simple. It just means that even with a trade deal on the books, both the US and China are actively trying to depend on each other less, especially when it comes to the big stuff like tech, data, and AI. So if you're a global fintech company,
That means regulatory risk and that feeling of uncertainty, yeah, that's not going anywhere.
Here's another fantastic analogy to help you wrap your head around this. Think of the trade deal like a halftime locker room pep talk during a really tense game. Both teams agree to play nice for the next quarter, you know? But the underlying rivalry, that fundamental competition, it's still there. The real game is figuring out how tech and finance are going to evolve with all this geopolitical stuff still looming in the background.
So, the bottom line at this macro level is this. Yeah, things might seem a bit calmer on the surface right now, but geopolitical risk, it is absolutely still a core part of the playbook for any company that operates on the global stage. You just can't afford to ignore it.
Okay, so we've looked at a single company, we've looked at a market, and we've looked at the global climate. Now for the final piece, let's bring it all home and connect all these fintech dots, going from just one player all the way up to the global game board.
And here it is. This is where it all clicks into place. You start at the micro level with Revoluts. Their big, bold ambitions totally depend on a stable global environment to pull off. Then you move up to the meso level with Synchrony. Their results are like a barometer for market health, which is directly influenced by that wider climate. And finally, you get to the macro level. The US-China relationship is basically the weather system that sets the conditions for every single player, big or small. You see, they're all deeply, fundamentally connected.
And that brings us to the final big question. When you look at this incredibly complex, interconnected system we've just laid out, it really forces you to ask, in the world of fintech today, where's the biggest risk? Is it buried in your lines of code? Or is it out there in the global climate? Definitely something to chew on.